All right, so today we're going to talk about the banking illusion and why the branch is not your financial home. They say to you, we'd love for you to meet our financial advisor. Translation, let's keep your money here and sell you something. I'm Casey Marx. I'm the founder of Crown Haven, Bull Baron, and Pinecone. I've spent 60,000 hours with real families. I've spent a decade and a half on radio, television, a career spent fixing so-called plans that come from the branch down the street. Subscribe, share, and follow me at RealKCA on X. And let's dismantle this banking illusion. This is the lie. A branch feels like home, right? Tellers, relationship managers, loan officers, CD specialists, everybody's nice. And nearly everybody is incentivized to keep your deposits sticky, to keep them there, and then hand you over seamlessly to sales. Once you hit a certain balance or roll a fat CD, you get the call. We think it's time that you'd speak to our advisor. That's not service, that's a handoff. Let's talk about how we got here. After Glass-Steagall fell through the Gramm-Leach-Bliley Act, which was blessed by Alan Greenspan, banks re-entered investments. On paper, they're a one-stop shop, but in reality, you have revolving door representatives inside a captive shelf. They manage hundreds, if not thousands, of households with vanilla high-fee model portfolios, captive annuities and insurance through preferred partnerships, CD ladders that are dressed up as managed income in the future, and planning that's really just allocation and a birthday card. These folks are trained to distribute what the bank allows them to distribute, not to architect what you need. So let's talk about how the comp really works here. How does the compensation work at a bank? Well, referrals get paid. Walkovers get bonused. The reps earn from the AUM fees they charge, front-loaded mutual funds, which is up to 5.75% depending upon the mutual fund, trading commissions, revenue sharing, annuity commissions, in-house fund splits. Here's a real client that I met. They were paying an AUM fee. They had been put into loaded mutual funds. There was a monthly service charge for administrative costs. All of that was 3% all in. The portfolio, when we did a diagnostic on it, was earning a 2.3% real return. That's siphoning. The branch felt safe to this person. It felt recognizable to this person. But they were paying Ritz-Carlton prices for a Motel 6 portfolio. So you gotta ask yourself, how does this happen? Well, you ask about a CD. You see their specials, but then you get walked out with a plan for a Roth IRA. You hit a certain balance threshold, and then you get pitched. You walk in for help for one reason or another, and you get internally routed. It feels like you're leveling up in a lot of ways, but it's boxed advice for mass distribution, and it's at scale. So how does this go wrong? Well, these folks, first of all, are juggling hundreds, if not thousands, of households, and they're doing multiple things at once. You're getting statements, you're not getting strategy, you're getting smiles, you're not getting scenario analysis, you're getting slogans, you're not getting proper sequencing, there's no tax coordination, no estate integration, no real plan. So what you're really doing when you go to the bank and you're getting a plan is you're paying full freight for passive models you could do yourself for 1/10 of the cost. You're getting pushed into captive funds and preferred partnerships with insurers because of the partnership economics. You're losing access to independent, tax-aware withdrawal designs. And as a result, you're living in a one-size-fits-all box from a checkbox risk tolerance questionnaire and getting zero coordination across taxation, estate, insurance, healthcare, you name it. This is like renting a microwave for $200 a month and being charged every single time you reheat the leftovers. So banks are not your homes, they're warehouses. They're custodians. They have a place, but how do they really make money? They make money on net interest margin. That's the spread between what you earn on your deposits and what they pay you to keep them there. Branding is not advice. Comfort is not clarity. And in real stress events, access can actually freeze. If anybody was alive watching this during the great financial crisis, you know what I'm talking about. And the logo won't save you. The branch is not your plan, but it can be your parking lot for a certain amount of assets. So when can a bank advisor make sense? At the product level, not the planning level. Short-term cash, short-term CDs if the rates are attractive enough and you don't want to deal with treasuries on your own. In high-rate windows especially. If you need simple lending and ideally with a local community-based bank that keeps an eye on what they're lending and who they're lending to. Basic transaction convenience. But your accumulation or retirement architecture or your planning needs? Absolutely not. Write this down, because this is your branch handoff defense checklist. Ask these before any bank referral meeting to an advisor, because now they've got these folks right in there. Are you a 24/7 fiduciary in writing, and will you put that in writing? Or are you acting as a suitability advisor? What percentage of what you recommend is in-house revenue or revenue sharing partners? How much independence do you truly have? If I want this, or this, can you go get it for me? What is my all-in cost in dollars, not in fees, in dollars? What's my AUM fee? What's my load charge? What's my admin fee? What are my service fees? What are my ticket costs? I want to know all of it. What's your capacity? How many households do you serve? And what's your service model look like? Okay, so you're a representative. How many households? Do you have a backup, or am I going to become an orphan account? What are the actions that you're going to take quarterly, or monthly for that matter? Or am I just going to receive a statement in the mail? Proof of integration. Is there any coordination with my CPA or my estate planning attorney or my insurance professional or my healthcare professional? Are you going to sequence my income? Are you going to help me handle required minimum distributions? Show me it. And by the way, are you going to quarterback that team of professionals, or do I have to do it? Here's a really good one. Tell me the net benefit over a low-cost, do-it-myself approach after fees and taxation is considered. Because what it seems like is that you're showing me a passively managed model that will be strategically reallocated per your bank's thesis. And basically I'm paying a fee for you to hold my hand, to put out the fires when I get scared, and to rebalance me quarterly. If I wanted to be passive in the market, could I not just do that myself and put together a simple spreadsheet and rebalance myself quarterly and not pay 2 or 3%? If they dodge any of these questions or can't show you it on paper, walk. The final question, I guess, that I didn't even mention on that list is, if I leave the bank, what breaks? Does my service break? Who still serves me? Where are the assets custodied? What happens in that scenario? If you're watching this and your plan came from a branch, you don't have a plan. You have a payroll stream for a bank. You are a number in a CRM. So rewind, watch the checklist. Share this with the person who loves their banker, man. And subscribe. Next up, I am going to dissect the assets under management industry. Stay tuned.